Have you ever wondered why the US dollar depreciated against the Japanese yen and the German mark in 1985? A year that would go down in history for a significant economic event, a mystery that still sparks curiosity. The year 1985 was not just any other year for the world economy, it was the year of the Plaza Accord. This was an agreement that would set the stage for a dramatic shift in global economic dynamics. The mighty dollar, a symbol of American economic prowess, suddenly started depreciating against the yen and mark. A deliberate decision, orchestrated by some of the world's major economies, with the sole aim of reducing the US trade deficit. But this was not without consequences. It led to significant financial market volatility and far-reaching economic repercussions. The Plaza Accord, though a solution at the time, was indeed a double-edged sword. Stay tuned as we unravel the story behind the Plaza Accord. Before we dive into the Plaza Accord, it's crucial to understand the events leading up to it. The early 1980s was a period of economic turmoil and transformation. The United States, one of the world's leading economies, was struggling with a rising trade deficit. This deficit, the difference between what America was exporting and importing, was ballooning, leading to an economic imbalance. At the same time, the US dollar was exceptionally strong. In fact, the dollar was so robust that it was making American goods more expensive for foreign buyers. This, in turn, was exacerbating the trade deficit, creating a vicious cycle that was difficult to break. This situation wasn't just affecting the United States. The strength of the dollar was putting significant pressure on other economies, particularly those of Japan and Germany. These countries found their exports becoming cheaper and more attractive to international buyers, which was great for their economies in the short term. However, it also meant they were accumulating vast amounts of US dollars, creating an economic imbalance of their own. The strong dollar also made it more difficult for developing countries to repay their dollar-denominated debts, leading to economic instability and debt crises in several regions. This situation was unsustainable and called for a change. The world needed a way to rebalance the global economy and reduce the strength of the dollar. There were calls for intervention, for a collective effort to address this situation. Economists and policymakers around the world began to discuss potential solutions, and it became clear that a coordinated international response was required. This was not just about the US economy, it was about global economic stability. These discussions and deliberations eventually led to a historic meeting at the Plaza Hotel in New York City, a meeting that would change the course of economic history. This meeting was the precursor to what we now know as the Plaza Accord, an agreement that aimed to devalue the US dollar and reduce the US trade deficit. And so the stage was set for a significant shift in global economic policy. September 22, 1985, a day that would change the course of economic history. As the sun rose over the Plaza Hotel in New York City, representatives from 5 of the world's most significant economies, the United States, Japan, West Germany, France, and the United Kingdom, gathered in earnest. Their mission was clear: to address the surging strength of the US dollar and its consequential detriment to global trade. The American economy had been facing a massive trade deficit, largely due to the overvalued dollar. This made American exports expensive and imports cheaper, leading to a flood of foreign goods into the US market. As a result, American industries struggled, jobs were lost, and the economy wobbled precariously. Meanwhile, Japan and West Germany, the other 2 major players, were experiencing the exact opposite. Their currencies were undervalued, making their exports cheap and attractive. This led to huge trade surpluses for them, but also increased dependency on exports, which was not sustainable in the long run. France and the UK, although not as directly impacted, were nonetheless crucial players in the global economic system and hence were part of the negotiations. The solution was the Plaza Accord, an agreement to intervene in currency markets to depreciate the US dollar against the Japanese yen and the German mark. The plan was not just to lower the value of the dollar, but to do it in a controlled and coordinated way to avoid sudden shocks to the global economy. The US agreed to this, recognizing the need to boost its domestic industries and reduce its burgeoning trade deficit. Japan and West Germany consented to appreciate their currencies, understanding that an over-reliance on exports was risky. France and the UK also concurred, acknowledging the importance of a balanced global economy. After much negotiation and deliberation, the agreement was reached. The world's major economies had agreed to a significant shift in global currency values, a move that was both daring and unprecedented. The Plaza Accord was signed and the world braced for its effects. In the wake of the Plaza Accord, the world witnessed some dramatic economic shifts. The immediate aftermath was characterized by a rapid depreciation of the dollar. This was precisely the intended outcome of the accord, orchestrated by the world's major economies to address the burgeoning U.S. trade deficit. The dollar's value plunged relative to the Japanese yen and the German mark, currencies of two of the world's most robust economies at the time. The yen and the mark, buoyed by the accord, began to soar. Their ascent was swift and steep, altering the global financial landscape. As these currencies strengthened, their respective countries found themselves on the receiving end of a double-edged sword. On one hand, the rise in value was a testament to their economic might. On the other hand, it made their exports more expensive, impacting their trade balances. The trade dynamics began to shift. The U.S., with its now cheaper dollar, saw its exports become more competitive. The trade deficit started to shrink, providing a much-needed respite to the American economy. However, Japan and Germany, despite their stronger currencies, found their exports less competitive due to the higher prices. This led to a reduction in their trade surpluses. The financial markets, sensitive to changes in economic fundamentals, were not spared either. The Plaza Accord sparked a period of volatility. Markets were thrown into a state of flux as investors grappled with the new economic order. The currency's values fluctuated wildly, creating an environment of uncertainty. The impact of the Plaza Accord was far-reaching and immediate. It was a bold move, a grand experiment in global economic management. Its effects rippled through the world economy, reshaping financial landscapes and altering trade dynamics. The Plaza Accord had made its mark, but its story was far from over. The ripples of the Plaza Accord continued to be felt decades later. After the agreement was signed, the yen and the mark appreciated significantly against the dollar. Yet the intended effect of reducing the U.S. trade deficit was not as successful as planned. Instead, the Plaza Accord inadvertently contributed to the Japanese asset price bubble of the late 80s. The rapid appreciation of the yen led to an influx of cheap capital into Japan. This, in turn, caused a speculative frenzy in the Japanese real estate and stock markets. When the bubble burst at the dawn of the 90s, it sent Japan into a period of economic stagnation, often referred to as the lost decade. But the Plaza Accord's legacy extends beyond Japan. It marked a significant shift in the global economic power structure. The accord showed that international economic cooperation could influence exchange rates and potentially correct global imbalances. However, it also demonstrated the risks and unintended consequences of such coordinated interventions. The lessons learned from the Plaza Accord have had profound implications for global economic policy. In the aftermath of the accord, countries have become more cautious in managing their exchange rates, mindful of the potential for unintended consequences. The accord has also served as a stark reminder of the importance of economic fundamentals, rather than artificial interventions, in determining the strength of a currency. Moreover, the Plaza Accord has shaped the discourse on international monetary cooperation. It has spurred debates about the roles of major economies in managing global financial stability, and has informed subsequent economic agreements. In conclusion, while the Plaza Accord did not fully achieve its intended goal of reducing the U.S. trade deficit, it had far-reaching effects on the global economy. It precipitated a significant economic bubble in Japan, shifted the balance of global economic power, and provided valuable lessons for future economic policy. The Plaza Accord, a historic event that forever shaped the world economy. So, there we have it. The rise, fall, and legacy of the Plaza Accord. We've journeyed through the intricacies of this significant economic agreement, from its genesis as a response to the depreciating dollar, to its unfolding and the ensuing market volatility. We've also delved into its aftermath and the enduring consequences on the world's economic landscape. The Plaza Accord serves as a potent reminder of the importance of understanding economic history, as it provides us with valuable insights into the complex interplay of global currencies and trade dynamics. It underscores the pivotal role of economic policy in shaping the trajectory of nations, industries, and individual lives. As we navigate our increasingly interconnected global economy, the lessons from the Plaza Accord continue to hold profound relevance. The Plaza Accord, a testament to the power of economic policy and its far-reaching impact on the world economy.